5 ways rich people make money with debt. Both bad debt and good debt can be found in the world of finance. The term bad debt refers to funds that are owed on assets that are depreciating and have fixed payments but are decreasing in value. Possessing an asset through utilization of debt that goes higher in value and or generates positive cash flow that is more than the debt payment and expenses is an example of good debt. All debt carries some level of risk, but the borrower is responsible for paying for some debts while not others. Why does having debt make you wealthy? When you utilize the money of other people to control assets that increase in value and provide cash flow that increases your net worth, debt can be a source of wealth for you. Because of the leverage that is created by good debt, you can own an asset that is worth several times the amount of the monthly payment for a relatively small price. Instead of being based on your payment, your gain is a proportion of the asset that you control. A great number of firms begin with business loans to provide the proprietor with access to funds during the first phases of starting and operating the business. Additionally, the owner of the business is the owner of the business itself, as well as the value of future earnings and cash flow, while the banker is the owner of the right to interest on the loan and the payments. People can acquire the capital they require to build assets of value through the use of debt. Anyone can become a capitalist if they have access to credit and debt. What steps do wealthy people take to make the most of their debt? Those who are wealthy make use of debt to increase the returns on their capital by taking out loans with low interest rates and expanding their control over assets. When they have a sufficiently large credit line, their assets and money are leveraged to get loans that can be used for commercial and investment purposes. Their assets can generate returns while at the same time the money that they have borrowed is working effectively to generate returns and increase their net worth. Step 1. Leverage in real estate. Through the purchase of real estate, you have the opportunity to multiply your capital by multiples of 20 with a down payment of 5% or by multiples of 1,000 with monthly payments. A home that costs $200,000 can be purchased by a real estate investor with a monthly payment of $2,000 if the investor makes a down payment of $10,000. Not only do investors in real estate make returns on the money they put into the venture, but they also make returns on the total amount of the loan. Should the piece of real estate have a 20% increase in value, from $200,000 to $240,000, then the initial down payment of $10,000 will result in a return of 300% in conjunction with the investment return of $40,000. It is also possible to use debt to purchase residences or rental properties that are used every month, such as Airbnb, to generate cash-flowing assets that can be leveraged to generate monthly income. When it comes to cash flow, the returns refer to the overall debt rather than the money invested in the property, which results in significant returns. Step 2. Leverage buyout. The process of purchasing a company is referred to as a leveraged buyout when the buyer or buyers of the company take on a significant amount of debt as part of the acquisition process. To acquire the firm, the buyer will use assets from the company that are being purchased as collateral. The buyer intends to pay off the debt later, after the buyout, by using the cash flow that will be generated by the company in the future. When a leveraged buyout is completed, the buyer ultimately acquires a controlling position in the company that is being acquired. Step 3. Short selling. In the regular procedure of buying and subsequently selling stocks, selling short is the opposite of what happens. When someone sells short, they are selling something that they do not own. In the process of selling a stock short, you borrow the stock from your broker and then sell it to a buyer directly. The shares are then owed to the broker by you. The sale results in the receipt of cash, but you are required to spend that cash to purchase shares at a later time to repay your broker for the loan of shares. An example of a short side trade would be when you are long cash and short the shares. When you use the credit that is available in your margin account to purchase shares, you have incurred a debt. When you buy to cover the short position, the price at which you buy back the shares you were short on the open market will be the debit purchase price. After that, your broker will be able to return the shares to the account from which they were borrowed. All of this is carried out electronically, and it is computerized and mechanized at this point. The sequence of trading is reversed when a short seller is involved. They sell first and then purchase back into the market later. A profit can be made through the use of debt if you sell short at a price that is greater than the price at which you purchase it back later. While you are shorting a stock, you will also be required to pay margin interest on the size of the position that you are holding. Additionally, you will be responsible for paying any dividends that are payable on the stock during the period that you are short. When the stock market goes up or down, traders can make money in both directions by using this strategy. Traders can make money in both directions. Step 4. Margin account. When an investor has a margin account, the stockbroker lends the investor money or shares, using the investor's account as collateral to purchase securities. This sort of brokerage account is known as a margin account. Through the use of margin trading, your broker will raise the amount of buying power in your account, increasing the size of trades you can make and the number of trades you can make. When you utilize margin, you can increase the leverage of your trades or increase the turnover of your transactions more quickly. This eliminates the need to wait for your trades to clear when you join and exit the market. Increasing the size of your trades through the utilization of margin will increase the magnitude of your results. When you trade a position that is twice as large as the one you would have traded without margin, your profits are twice as large. However, if you lose a trade, the loss would be twice as large as it would have been if you had traded without margin. Investors and traders can increase the size of their total trade position by a factor of 2 when using margin accounts, provided that the stocks they purchase are capable of being utilized for full margin. The most fundamental benefit of margin is that it enables day traders to keep their buying power without having to wait for all of their trades to clear. Step 5. Using debt for living expenses. Investors can avoid paying income tax and other taxable events, such as selling assets for capital gains, by paying their living expenses with debt. For instance, they can take a margin loan on their portfolio holdings with their broker without having to sell any of their stocks at the moment. They can then pay it back later by selling equities that are down, which will result in no capital gains tax being incurred. It is also possible for people with a high net worth to live off lines of credit that are guaranteed by their assets and to only pay off their loans from sources that have the most favorable tax structures. Examples of such transactions include the sale of a personal dwelling, which is exempt from taxation in the majority of states, the sale of investments that are losing money, dividends that are subject to a lower tax rate than income, margin loans, and capital gains on stocks that are subject to a lower tax rate than a high income tax bracket. How do billionaires make a living thanks to loans? Let's take a look at Elon Musk as an illustration of a wealthy individual who can maximize their tax liability to make money from their debt. When the richest guy in the world needs some cash, he has the opportunity to borrow money and use debt to pay for living expenses, or to use it to attempt to acquire businesses such as Twitter. As an alternative to selling his shares and subsequently having to pay capital gains taxes on the earnings of a sale, he can use his holdings of Tesla shares as collateral for credit lines. This is an option to sell his shares. Musk has access to billions of dollars in cash whenever he needs it for any reason, thanks to the fact that his pledged shares of Tesla serve as an ongoing credit facility. Would you like it? Hit the like button and subscribe to our channel for more interesting and informative videos.